Great. So thank you, everyone, for joining today. We have our panel of myself, Winter Mead from Sapphire Ventures, and Joe Schorge from Isomer Capital. Thank you, SuperVenture, for hosting this panel. Ahead of the event, which is scheduled for February 27 and 28 in Berlin. So I will introduce myself a little bit. I work at a fund called Sapphire Venture in Palo Alto in sunny California. We have a dual strategy at Sapphire. So we have a direct team that started in the mid-90s, and about 5 years ago, we started a fund investment program as well. So we have a billion-dollar evergreen vehicle that looks to invest into early-stage venture capital funds. Before Sapphire, I was with an SEC-registered multifamily office called Hall Capital, based in San Francisco. Joe Schorge, who is my co-panelist, is founder and managing partner at Isomer Capital. I'm going to pass it over to Joe to introduce himself.
Thank you, Winter. My name is Joe. I founded Isomer Capital in 2015. We focus on European early-stage technology, and we do that in three different ways. First, by investing as an LP in venture capital funds. Secondly, by co-investing alongside those funds into some of their companies. And thirdly, by buying secondary positions in both the funds and companies as they evolve over time. My background, I spent the first decade of my career running IT departments. I have a computer engineering background, and then I did an MBA and got into investing, predominantly working for Cambridge Associates in London, and investing a lot of institutional capital into private markets across the world. And also at Pomona Capital, a secondaries firm, who I also work for in London, which I have to admit, sadly, is a little bit less sunny than where you are now, Winter.
Good. Well, everyone, I want to encourage people to submit questions as well via the Q&A box, and we can get to those at the end of the session. So let's kick it off, Joe, with a few questions of our own. So the first question, more LPs, limited partners, it seems, are starting to look at that venture capital, many for the first time, including in Europe. Investing, how are they going to do this? How are they going to get into venture capital? It seems like the first step a lot of people are taking are investing into fund of funds. I'm curious to hear your thoughts on this.
Certainly. Well, I mean, my view is that technology and therefore the way digital companies are built has gone through a revolution in the last decade, and the way those companies are financed and how venture capital is operating has also gone through a revolution. And so, entering this market is unlike entering other parts of private markets, which are more mature and which I would argue change less over time. And so certainly we talk to a lot of LPs who have never invested in venture capital before. It's pretty obvious that the world is being digitized now, and there are lots of exciting new business models and exciting companies to invest in. But it's pretty difficult to figure out where and when and how to invest. So we founded Isomer Capital as a fund of funds in part to really help with that. It's taken us 20 years to build relationships and networks in the technology industry. And if we think about what we're really doing, assisting new LPs into the asset class, on a tactical level, we're helping them diversify quickly to manage the high risk reward profile that's normal to venture capital. And we're helping them build their own networks and knowledge so that over time they can develop their own points of view and their own ways of investing. And of course, as you know, Winter, there are lots of ways to invest in technology companies, directly into companies, into funds, or into kind of a pre-diversified portfolio.
I think that's right. I mean, I can talk a little bit more about the Sapphire strategy. Our logical first step was investing directly into companies, starting in the mid-90s. And again, we sort of went from direct to investing in funds. And I think the ability to access the innovation ecosystem. Our limited partner is SAP. And while we are structured as an evergreen vehicle that's financially oriented, we definitely have the ability to get to what we're seeing, in the greater market by having a fund investment program. And I think that's valued pretty highly by our own limited partner and by the GPs in which we're investing as well. So I'm going to jump to question 2. Along with permanent access to capital, which all GPs want, GPs want the LPs to move efficiently and rationally. Curious also to get your thoughts on this and whether you think that's the right setup for the limited partner. And what else are GPs looking for from the limited partners? And lastly, how do you, Joe, stand out at Isomer Capital?
Yeah, it's a big question. We could hold a conference on that alone, but I could sort of summarize the headline by simply saying, being a good business partner really distinguishes one LP from another. And what do I mean by that? I mean, very simple things matter, like clear communications, giving timely and honest feedback. So many LPs do a lot of research, but maybe never really tell funds what they think or whether they're actually interested or just collecting data. So we find that we've developed a pretty straightforward approach. What you see is what you get, and GPs seem to really like that. They know where they stand, and the good GPs like that and like the two-way dialogue. So we may disagree on things, and we can have a great discussion. Whereas if we never tell them how we disagree or what we're thinking, often we don't, bring out the more complex issues that they see in the market, which is great learning for us. And I guess the second part of activities that I think can distinguish one LP or make you valuable to a GP is adding value when possible. And every LP has different elements they could add to an investment program. And that's everything from, obviously the finance side, from helping in subsequent financings or acting as a reference point to other investors or so on, to actually helping business development initiatives in underlying companies, building networks where you can help companies enter different markets or help VCs access good co-investors. And then, as we work with a lot of new technology GPs, we find that helping them, well, let me take a step back. The dominant profile of those newer teams are they tend to be great tech people and new fund managers. So by providing thoughtful advice and assistance on fund management issues and strategy and benchmarking and stakeholder management, and which a lot of LPs see a lot of data and know a lot. And if you're willing to share your time and your energy with GPs, I think they really value that and therefore value you over time. How do you see those issues, Winter?
Yeah, I largely agree. I think the permanence of capital was a pretty big issue early on when we started the vehicle. VPs, of course, are looking for limited partners that are going to be there over time, over multiple funds, to sort of ensure that's going to be possible. Was the reason largely last year we decided to transition to an evergreen structure and raise more capital for that vehicle. So that enables that permanence of capital, I think. And then how can we also stand out? Like I mentioned earlier, part of the dual strategy, having a team that's on the platform that's doing direct investments at the later stage all the time, I think gives a perspective and insight into what's going on at later stages in the market, what's going on in the public markets, and being able to bring that information back to inform our decisions when we're investing into funds and in early stage venture capital. We try to as well to drive transparency, get to decisions quickly by being informed all the time. So I mean, if we're always focused on venture capital, if we're always doing work there, you get to know the players quite well, and therefore I think it can help drive faster decisions, which in turn helps the GPs, whether that's positive or negative. If it's positive, it's great, and you're starting a partnership or renewing a partnership. If it's negative, it means that GPs have a clear decision up front, and they can move on and focus on more high priority limited partners when they're out fundraising.
Yeah, I guess also what you're saying is something we think about, which is you can bring a longer term pattern recognition to GPs as well, where you may be in an advisory meeting and they're taking some decisions, and you can say, well, we've seen that in other funds and in other time periods and so on, and that's bringing that particularly to emerging managers is extremely useful, and we think can drive better outcomes within the funds you invest in if you build that trusted partner status and you're able to advise in that way.
Yeah, I think that's right. I think the last point of our platform where we try to differentiate is because we have SAP as a limited partner. They've been helpful and progressive in the way they think about bringing value to the relationship. And so we actually have a dedicated team internally called Market Development that works to derive business development relationships with the Global 1000 that's working with SAP. And we try to do it in a systematic way that's helpful for GPs. So once we're in partnership, we try to add value as an active LP there. I'm curious, investing into funds is one thing, but doing co-investing, Joe, how are you doing it at Isomer? Like, how are you looking to make co-investments with your GPs, and sort of how does that work with your fund?
Sure. Well, we see co-investing fundamentally as an extension of our partnership with the VCs. I don't know how well you know the European environment, but there's far less capital available in Europe, about 5 times less than there is in the U.S., for a similar number of startup companies. And so it isn't that you hope to get co-invest. It's that actually VC funds tend to be small, and when companies start to progress really quickly, they need capital. And so part of being a good partner for us is to have that available. And the type of co-investing we like to do is from a position of knowledge and network. So we're really co-investing alongside our portfolio VCs, not anywhere in any company we find. But I believe to think carefully about co-investing, you need to track companies for for months and years and follow their progress, get to know the management teams, and to really work in concert with the VC or several VCs, which can be involved. And so we, all of the normal financial rules apply. We're, looking to access companies directly and get the benefits of that. But we're doing that from a more deeper relationship and as they say, as a good partner. Is that similar to your program?
Yeah, I think that's right. I mean, it's the co-investment strategy is, I would say, part of the strategy, but definitely not a core focus. I mean, when we're investing into managers, we're looking to underwrite the fund return, and then if we can provide co-investment capital where it makes sense, we will do that. And then again, we have a separate fund that does the direct investment. So if there's the right partnership there with the growth team or the later stage team, we will make that introduction. It's not binding and it's not really expected when we invest into the fund, but if it's there and it makes sense for the right company, we'll look to do a co-investment or a follow-on investment through either the fund vehicle or the growth vehicle that sort of sits alongside of the fund vehicle. I wanted to you touched on a point there, especially in Europe, as you're looking to build those relationships over time with, GPs that are going to be in your portfolio, when is the right time when you're going to make that commitment? Like what amount of data do you need to actually, make that decision and say, yes, this GP is going to be in my portfolio?
Well, it's interesting. There's often not a specific tipping point. Most GPs that we invest with are people and teams we've known for years. And what we're doing within Isomer is really backing people. So the fund structure in terms and all of that really is a hygiene factor. And what we're looking to do is back people who have an outsized advantage, some edge within their market, which can be sectoral or can be geographic or can be developed in different ways. But we develop relationships with these people over a period of years, and often we help them develop their fund proposition. And we do a lot of, I would say, free consulting with GPs to help them and build up their own fund strategy and their own firm strategy. And then sometimes we invest. We can't back everyone, but yeah, it's an interesting question. I don't have a solid answer. When is the moment We have an investment committee, and everyone has to know. Everyone has to agree. It must be unanimous. So it's not enough for one person to know, but someone has to argue convincingly that a particular fund is additive to the portfolio, and to argue its merits and to convince their colleagues. So from that standpoint, you never really know until you've had an IC meeting and understood the team's position.
Right, and I'm sure it helps having been in the tech ecosystem now for 20 years. You know who the people are you want to back. I'm sure. Jumping to the last question we had formally before getting into some of the Q&A from the attendees. What is your opinion on having been in the tech ecosystem now for a long time, having been in the LP world now for a long time? Do you feel this is necessary for an LP to have that type of history working with GPs and working in technology to be an effective LP?
Well, it helps, but I don't think it's the only way to be an effective LP. I mean, when you invest in a fund, you're essentially outsourcing the investment decision to a very specialist team. So any LP doesn't do well to second guess what the manager is doing, but more to work in concert with them. So I think technology investing is a very specialist activity. So it is helpful to have worked in technology and develop software or manage development teams and so on. But it's certainly not the only way. And certainly if you bring value in other directions, at the end, the companies we build are businesses, and they're enabled by technology. But most of the time in venture capital, the product itself is not technology. It's a business service, or sometimes even a piece of hardware that works with software or whatever. And so the business of bringing those products to the world and helping launch them in other markets, that's not a technology activity. So that's a game all LPs can play if they want to. But I would argue that the sourcing and selection is quite specialist, and you need to spend some serious time and dedicate a team as you have and as we have to really understanding what's going on the ground. Everyone has a lot of references that speak well about them, but if you can get behind that and talk to entrepreneurs that VCs have backed and talk to situations that have gone well and not gone well, and then you start to build up a more rich picture and can develop confidence in who you back and when.
That makes sense. So I want to jump into some audience Q&A. I guess the role of the limited partner, do you feel it's changed over the last 5 years, or in a more active environment, especially in the U.S. where there's now many micro funds? Depending on whose number you believe, over 500. So it's a busy ecosystem in the U.S. I'm wondering if it, in your opinion, feels the same in Europe, and then how do you respond as an LP to that type of environment?
Yes, it's a very busy environment. I'm not sure that there are as many funds in Europe as the U.S. It's less a mature market, but we're tracking 450 funds at the moment across the whole venture spectrum. So those are not all micro funds, but there certainly are a lot of them. Our view on fund size is that it really you can make good returns at different sizes. The more important factor is that the fund size is designed and relevant for the underlying opportunity. So if you're investing very early and very small amounts of capital, then the fund should be appropriately sized and small. Or if you're coming in much later and doing relatively fewer larger deals, then a larger fund size would fit. But you're right. The level of fund innovation today is amazing. That's part of what caused us to found a new firm, because we see so much great innovation within companies, and on top of that, innovation within the venture capital community to go after that opportunity.
Great. I want to encourage some of the audience members as well to submit questions via the Q&A tab on the bottom of the screen share. So the next question is, do you see LP interest in VC fund of funds increasing?
I do see it increasing. It's kind of interesting, but that's not the way I see it. In a funny way, if I just think of conversations over the past 3, 4, 5 weeks, we see lots of different groups who want to access European technology and innovation. I'll give you an example. I just was in Japan a couple of weeks ago, and it's clear within Japanese corporates that Europe is creating lots of great innovation, lots of great new companies. But there's a question mark within many of those organizations as to how best to access it. They can put a person or two in Europe and go around and meet companies, but it is such a vibrant, busy space that, as you said, Winter, it's hard to filter and get your arms around it. So from that standpoint, there is a lot of interest in fund of funds as a window into the market and as a way to build a network.
Yeah, and I see similar things here. Institutions will approach us as potential limited partners trying to get access to venture as a potential source of yield, or again as an innovation ecosystem, and looking to work with us. To your point earlier of appropriately sized funds, you can't accept all the capital even if there is a demand there. I think one of the follow-up questions is, even if there is demand, sort of what is the appropriately sized fund for Europe? Not on the LP structure, but on a GP fund. For when you're looking for GPs, what do you feel is sort of the right fund size? And I guess how do you respond, as an LP fund size over time?
Yeah, so the way we do it is through bottoms-up analysis. So every fund we work with, we sit down together and spend a lot of time modeling out, based on the number of companies and the type of companies and the stage of investment that the fund will be investing in. We do a bottoms-up model, which essentially says, here's a number of companies we're entering at this point, and the average stake we predict is X. We'll follow on one or two rounds with this sort of reserve ratio, and then we'll make an estimate about the attrition rate. About some companies don't work, and some companies we lose confidence in, and so on. And so from that, we end up with a fund size, which I think is a more robust kind of model, rather than simply say, 100 is great. And that's how we go about linking the fund size to the opportunity set. I'm an engineer by background, so that the nuts and bolts approach kind of feels most comfortable to me. What I would say is the larger the fund you have, been proven out in the U.S. over decades, the harder it is to develop a higher money multiple, because you're coming into companies later. So we look to go earlier, and given the European state of the market, we tend to look at funds that are 200 or less in size.
I think we're big believers in appropriately sized funds as well, and tend to look closely at portfolio construction, when we're underwriting and in diligence. It looks like we have time for one more question. There seems to be some interest from the audience on, we'll call it emerging markets, but it could be, in Europe, maybe call them, the non-Stockholm, Paris, Berlin, London markets, where, you have burgeoning ecosystems, you have, funds that are focusing on those ecosystems. What's your view on the opportunity set there?
Yeah, it's an important question. We think about it every day. I started very early by saying I think there has been a revolution in technology over the last decade, which is continuing. And part of that revolution is that the cluster effect continues. It is important to have a critical mass of talent and capital and so on. However, at the same time, companies really start everywhere now. So in the early stages, we think a lot about how do we discover the next big thing when it doesn't arise in one of the major hubs, and increasingly it doesn't. For example, if I said to you 10 years ago, Europe's first $10 billion startup will come out of Helsinki, a very small Nordic city of 600,000 people. I mean, you would call me crazy at that time, I think. In fact, that's what happened. So that's very exciting, and it creates an opportunity, but also a focus for us to develop a sourcing network that takes that into account. And that's a long way of saying that emerging markets can be just as rich within the startup world as mature markets, because a lot of the startups we're looking to back are not based in their market wherever they started. You know, if you think about Supercell example I just described, it's a global product. It was born in Helsinki, but it's being sold all around the world. I was in Austria last week in Vienna. One of our most exciting companies came out of Vienna, and their customer base went global very, very quickly. And you know, they're not selling to customers in Vienna, but they have some great developers there and great business development people. And so yeah, I'm agreeing with the questioner that I think the opportunity in so-called emerging markets is big, and that's related to the fact that tech cuts across borders.
That's a great answer. Well, great. I think we're out of time. Thank you, Joe. Thank you to our friends at SuperReturn, which is, again, being hosted next week in Berlin. So hopefully we'll see some of you there. And, you know, I'll just end by saying it's a really interesting time to be a limited partner in VC. There are a lot of great opportunities, you know, that are expanding sectorally and geographically and in a lot of other dimensions. So thank you, everyone, for the time, and hopefully see you next week in Berlin.
Thank you, Winter. See you next week.